Hi, everyone. We're just going to wait another minute or two and let people continue to filter in, and we'll get going shortly. Thank you. Good afternoon, everybody. Thank you for joining us for today's webinar, How to Prepare for LIBOR Sunset and Developing Strategies for a Steepening Yield Curve. My name is Andrew Paolillo. I'm the Director of Member Strategies and Solutions here at the bank, and joining me on the call also will be Dan Redmond, who's our Vice President and Money Desk Manager. So we're excited to have everyone here today and to go over these two topics that are certainly front of the brain for a lot of our members. So at this point, we're going to jump right into Dan, and he's going to discuss some of the things that are going on with the LIBOR and SOFR transition. Dan?
Thank you, Andrew. Good afternoon, all. Thank you for attending today. Thanks for taking out time, busy time of year, I know, for a lot of people, both for business-wise and holiday-wise. So thanks again for being here with us. And so I'm just going to talk a little bit about a relatively popular topic as of late, the LIBOR transition, or transition away from LIBOR over to SOFR. I know people have differing levels of concern on this topic, and hopefully we can highlight some things today that maybe you were aware of, weren't aware of, or maybe raise your attention level a little bit on what we think is something that deserves quite a bit of attention at this point. So just highlight why we're talking about this. So LIBOR, publication of LIBOR no longer guaranteed beyond December 31, 2021. Some people think differently. Some people are less concerned than others. I will say I read this quote from John Williams, the president of the New York Fed. In a speech, he said there are three guarantees in life: death, taxes, and the end of LIBOR. So he obviously seems pretty serious about it. A lot of the regulators seem serious about it. So it's something that definitely requires some serious consideration. Why are we here? Why is LIBOR going away? LIBOR, as I'm sure everybody knows, the most commonly referenced benchmark globally. You're talking about over 200 trillion in financial contracts tied to the U.S. dollar LIBOR. The majority of those are derivatives, but it's not uncommon for LIBOR to be used to price adjustable rate mortgages or consumer loans. So as a result, LIBOR touches at a ton of different levels. It's not just the big banks or the broker dealers. You're talking about consumers and small businesses are affected. So a lot of your customers are affected as well as you. So it's important to pay attention to the topic. And a few years back, as I'm sure you remember, LIBOR was exposed. There was a rate rigging scandal. It kind of shed some light on the rate setting process that's associated with LIBOR. And when it got fleshed out, I mean, it was really, the fact of the matter was, you're talking about rate setting process that relied heavily on expert judgment. There were very few unsecured transactions, underlying transactions associated with the rate setting, LIBOR rate setting process. Think about 3-month LIBOR, probably the most popular LIBOR tenor. There are fewer than $1 billion worth of transactions on a daily basis, which is relatively thin. And in the end, it was determined as a result, the rate setting process was fraught with fraud and collusion. So the UK's Financial Conduct Authority, that's the agency that regulates LIBOR, decided that they were no longer going to persuade or compel banks to submit rates for the calculation of LIBOR beyond December 31, 2021. They expect that these panel banks will submit up until then, but after that, it's anybody's guess. So I think there are some people out there who believe LIBOR will continue on. There are some who even believe that even prior to that December 31 date, that people will lose faith in the index. Maybe some of the fewer panel banks will submit. As people move away from it, it'll be less reliable index. So it's good to be prepared prior to that date too, just in case you can't rely on LIBOR up to 12/31/2021. I will say, I'll hit you with another heavy quote too. Actually, I mentioned the Financial Conduct Authority. Andrew Bailey, who's the head of it, recently concluded a speech by saying the base case assumption should be that there will be no LIBOR publication after the end of 2021. So once again, another serious comment there, just to let you know that really we're heading in this direction, and it's probably pretty definitive that the LIBOR goes away in just over 2 years. So as a result of that, the Fed made a move to examine an alternative reference rate. They put together the Alternative Reference Rate Committee, or ARC, which you're probably familiar with, back in 2014. They were charged with determining the implications of a LIBOR phase-out. They also needed to identify an alternative index to LIBOR. And then they also had to, most importantly, develop a transition plan and an associated timeline for the transition from LIBOR to this new reference rate. And in 2017, the ARC came back and said that the secured overnight financing rate was their reference rate of choice, or also known as SOFR. And the SOFR, why SOFR? SOFR is kind of everything LIBOR is not. It is what the markets would refer to as a risk-free rate. It's calculated and published by the Federal Reserve, the New York Fed. It first started publishing back in April of 2018. It is an overnight rate, and it's based on transactions in the U.S. dollar Treasury repo market. As I had mentioned before, how a 3-month LIBOR market was really thin as far as transactions are concerned. The U.S. dollar Treasury market is the largest rates market at any given maturity in the world. So it's deep and it's reliable, and it's been around for quite some time. The rate itself, or SOFR itself, is produced in a transparent manner, and it's based on, as I said, observable transactions. So where there's a lot of speculation involved with the LIBOR rate setting, this SOFR is very hard to manipulate in comparison. So it seemed like a logical choice. I know out of the gates, just like with most everything, SOFR is new, people are unfamiliar with it. Adoption was relatively slow out of the chute. And I get it, it's something new. You're talking about just strictly an overnight rate where we had this term run for LIBOR for so long. But it's not the first overnight rate that's ever been out there or been used as an index. Your Fed funds are out there, that's overnight. Overnight index swaps, also overnight, and prime, for all intents and purposes, overnight rate. So there is precedent out there, but people need to adapt to it. And it's been occurring. We're seeing more and more usage. It's definitely becoming more prominent in the market, and the use of it has been on the rise. And as I mentioned before, the ARC was charged with developing a transition plan, and they've offered a tremendous amount of guidance in reference to how institutions can use SOFR to price, how they can price specific products, how to handle the transition, and guidance on fallback language. This is an important one too, because regulators are really harping on institutions, or encouraging institutions to examine fallback language in existing contracts and come up with very robust fallback language for new contracts. Because as I mentioned before, we're talking about SOFR now, talking about LIBOR out to the end of 2021. LIBOR could fade before then. If you don't have some sort of backup that explains in your contracts the transition to how you're going to transfer from LIBOR to SOFR, then issues could arise. So it's something that's well worth taking the time to examine. As I said, there's a lot of information out there. ARC could put out a lot out there. There's one good piece, great piece actually, the New York Fed put out back in April. It's simply and very appropriately titled The Guide to SOFR. And I think it's very encompassing as far as telling you about the rate, how the rate works, how to utilize the rate, how to accrue for interest, and what have you. So if you haven't taken a look at that and it's something that you have interest in, it's definitely worth checking out. So I mentioned one of the tasks for ARC was to come up with a PACE transition plan with objectives, milestones, and here's a timeline, and it's not as crisp as I would have liked. It's kind of an eye chart, a lot going on there, but I think it gives a good feel for how long this has been taking place and how much has been accomplished to date in relation to this transition. And it's quite a bit. They're right on track, if not ahead of schedule, with what they wanted and what they're looking forward to, what they wanted to get done. So there has been a lot accomplished, but there is still a lot to be done. One of those things is they want to continue to build liquidity in SOFR markets, want to grow the futures and swap market. Those are still developing, but they are developing more and more quickly, which is good. The ultimate goal, if you see at the very end of that timeline, is to have a forward-looking SOFR term reference rate. And that is a challenge for the fact that there's no cash market in the U.S. with enough depth to build a reliable rate on a daily basis. So it's real easy with that overnight treasury rate. Like I said, it's super deep, and they can go to that very easily. Term treasury repo market is much thinner than the overnight, so it's going to take some time. The Federal Reserve, actually some of their economists published a research paper recently demonstrating how forward-looking term rates can be derived for SOFR from futures and swaps. So they're definitely heading in that direction, and they feel that it's something that can be accomplished and will be done so before that drop-dead 2021 rate. But they definitely don't want people waiting on that. They don't want them sitting on their hands waiting till the term rates are available, start to utilize the overnight rate, figure out how you can use it, use the guidance that they're providing in order to use it on a day-to-day basis and get comfortable with using that index. And that's occurring. Like I said before, we are seeing more and more use. Recently, we're seeing fixed to floating debt issuances where flow to the floating leg of the issuance cites or points to 3-month LIBOR. Not 3-month LIBOR, actually 3-month SOFR, which shows confidence in the market that that is going to be there at that point. And one of the other accomplishments that's on this timeline, it's in the to-do, but recently has been done, is that ARC recently finalized recommendations for fallback language for several different instruments. So that's out there too. So if you were concerned and you were looking for something or some sort of guidance, that is readily available. As far as the transition is concerned from a bank perspective, from the home loan bank system and the individual banks, it's something that's we've been very active with over time. The system has been very actively involved in the process. We've had several representatives in related working groups, industry working groups that occurred that are working directly with ARC. The system has been a lead issuer with other GSEs, a lead issuer in SOFR index debt. As you can see by those numbers, pretty sizable. A big chunk of that market is home loan bank related. Early on too, our regulator came to it more on a district level as opposed to the system level, came to the district banks and charged the banks to develop a plan to prepare for LIBOR's phase out. And what we did in Boston, I think it's occurring in all other 10 districts also, but what we did here in Boston is we established a cross-functional LIBOR transition working group. So we've got representation from across the bank, from our treasury group and our marketing group and IT and legal and treasury and what have you, and you name it. And we put everybody together and kind of charged them with inventorying and examining the LIBOR exposure that we have at the institution and estimating just how we would be impacted by the transition. On the surface, it seems easy, right? You just look at our advanced products that are tied to LIBOR, but it goes so much deeper than that. We've got to take a look at our funding and hedges and pledged collateral and pricing and contract language, and it goes on and take a look at our systems. There are a lot of different aspects that we have to take a look at, and we've been doing that. And one of the important things too, as we work through that process, is to figure out how we communicate what we're doing to our members and how we can help to educate our members on the topic and what's going on here at the bank and beyond. So one of the first things that came out of this transition working group is that we did restrict maturity on certain advances to December 31, 2021. If you'd seen that back in January of this year, we made an announcement. It's listed in our products and solutions guide. So we did restrict products that were either LIBOR indexed or dependent. So anything that directly prices to LIBOR and or is hedged by a LIBOR related derivative. So we restricted some of those products, all those products. We have internally been trying to develop the ability to hedge vehicles, utilize new hedge vehicles to hedge some of these products. Again, mentioned the overnight index swap earlier. That's something that's playing a big role now and has allowed us to reintroduce some of the products that were on the restricted list. And we're developing new products also. We recently introduced a SOFR indexed floater. So that rolled out back in October. In a few minutes here, I'll give you a little bit more detail as far as what that is and what we're doing with that. And like I said, it's a lot of time and effort on our part to be prepared, and it's still ongoing. We've been asking members for a while now what their level of concern was, what they're doing. And I'd say going back a year or so, there was very little concern. It was not on most members' radar screens. And that has definitely changed over the course of the last few months. When we reach out and talk to members, they're asking more questions about this. We're getting a lot more reverse inquiry about the topic. And I think what we suggest, and similar to what we did, if we could make any suggestions, is don't wait to address it. 2021 is coming. I think off the top of my head, December 31, 2021 is only 750 days away. So it's coming fast. It sounds like a long time, but it's really not. And especially now, having worked on this transition team, I see how quickly this is happening and how much needs to be done during the time frame. So it's worth your time and effort to try to coordinate something internally to assess your exposure. You may look at things from 30,000 feet and say, yeah, we don't have LIBOR exposure, but you'd be surprised. Maybe some of your customers do. Maybe it's embedded in prepayment language and contracts you hadn't thought about. So it's worth doing that deep dive. And like I said, we did here in the bank is we went across the bank. We had representation from a bunch of different departments. So draw in as many people as you can to do that. I think that goes a long way. And just kind of think about the exposure on existing transactions, evaluate the fallback language in the contracts that you have outstanding, and then think about the contracts on a go-forward basis, getting some sort of robust fallback language embedded in those contracts. And like I said, ARC's out there, other regulators or institutions are out there. They've got some language out there you can fall back on. And then formulate a plan. Know what you want to do, know how you're going to regulate that exposure on a go-forward basis. And the absolute number one thing is stay informed. There's so much information out there. Stuff is changing on a day-to-day basis. It's very easy to go out and follow ARC, follow ISDA, follow SIFMA, and they provide a tremendous amount of guidance, and definitely rely on that. And I think that's a great resource, and it's right at your fingertips. And as far as resources are concerned, like I said, we're getting more reverse inquiry from members on the topic. Do not for a second hesitate to reach out to us. If you think that we can provide some information that would be helpful to you, we are more than happy to help educate on the topic as we're doing today, and then also help with any type of product transition. And we're happy to take any feedback. Like I said, we've got new products that we just rolled out, trying to roll out some old products with different variations. Keep the lines of communication open. If there's something you are seeing or not seeing that you want to see, you want to change, definitely let us know. We're here to help. As I said, we've gone through a lot of this already. So, please lean on our experience when you can, when necessary. So I mentioned the SOFR Index Advance. So that rolled out for us October 18th this year. So just to go over the terms real quick, it is adjustable rate advance with a final maturity up to 20 years. We're pricing on a daily basis at SOFR plus a predetermined static spread. So that depending on the final maturity, that spread would be determined at product initiation, advance initiation. Again, daily interest calculation, it's a simple interest calculation at this point. We reached out to some members regarding simple or compound interest, and it seemed from a systems perspective, it was easier to manage simple interest. That's the feedback we received. So maybe you see another variation at some point in the future that does offer compound interest option. Interest on the product is paid annually, and principal is at maturity, and the advance can be prepaid at any time, subject to a fee. And further on the product front, I will say that I had mentioned before the restriction that we put in place back beginning of this year on LIBOR index or dependent products. We have been able, due to our Treasury Group's diligent work, to kind come up with alternative hedging options, and we have been able to pull a couple of those products back off the restricted list. Back in April, we reintroduced the symmetrical prepay advance, and then just recently, back in October, we reintroduced the HOB option advance. You may be familiar with that one. That's a popular product for us. It's a fixed rate product where you sell the buy down the rate by selling the home loan bank the option to cancel the advance at certain intervals. So since October, we've rolled out a handful of successful offerings in that product, and we've had some good luck. Members have been happy to see that. Similar to anything, as I mentioned before, if you're interested in that product or another product, don't hesitate to give us a call, and we'd be happy to work with you to get something done. And again, another eye chart option there on the right, I included the list of advanced products that still remain on that restricted list. So there are about 13 products on there still. We're going to work, kind of chip away at that. Surprisingly, it takes a lot of time and effort to get these things back up and running in this alternative manner. So we have to be selective as far as what products we're going to pull up the list and which ones come first. For us, it's very easy to go and take a look at prior usage. And that being the case, we'd probably point to the flipper advance as the next product that we would go to. But if there's something on that list, if there's something that you see there that you feel would have value, definitely let us know, because we are going to base what we do predominantly on your feedback. So in the timeline, as far as reintroducing these 13 products or introducing additional products, are going to be based on your feedback and what we hear from the membership. So please keep the lines of communication open. As I said, any questions on the topic at any point, please don't hesitate to reach out. At this point, that's it for me. I'm going to turn this over to Andrew, and he's going to tell you how to take advantage of the current interest rate environment.
Thank you very much, Dan. We appreciate that. And before we get going on the second part of the webinar here, I do want to point out on the right-hand side of your screen, you should be able to see an area where you're able to submit any questions. So if you have anything on the LIBOR SOFR front, or as we get going here on the strategy side, please feel free to reach out and let us know if there's something we may be able to address for you. So what we're going to try to accomplish in this second section here is to talk a little bit about what the yield curve has been doing in 2019, in particular, the changes, the significant changes that we've seen in the last few months, and what is the impact on the balance sheet and the income statement of these recent shifts. But most importantly, rather than just talk about it, what can we do going forward to mitigate some of the risks and or enhance some of the return opportunities. So if we look at the yield curve, or rather the steepness of the yield curve, so here we have a view of what two different tenors or groupings of tenors have done so far in 2019. So in blue, you have the 3-month versus 5-year slope of the Treasury curve, and in green, the 1-year and 3-year Treasury curve. So you can see pretty clearly in the very beginning, the trend was towards a flatter yield curve. As we sat here last year, that the market was forecasting 2 potential rate hikes, but then something flipped and the bond market didn't believe the Fed's forecasting, and they were starting to anticipate cuts coming into play. So as we got towards the middle of the year, you can see we've annotated on the graph there that the yield curve at the 3-month versus the 5-year was inverted by 65 basis points. And for everyone in this call who's responsible or contributes to the balance sheet management process, you know that is not a formula for managing a balance sheet where with that level of inversion. Certainly, when you couple that with a tight credit spread environment across both the loan and the investment landscape. So as we zoom in on the second half of the year, well, we start to see a different picture versus that relentless flattening and push into inversion that we saw through the first quarter and the second quarter. So I've marked where the Fed actually did begin to cut rates here 3 times in the last couple of months. And after the first cut, the key takeaway, and you saw in all the headlines and the recaps, was that Chairman Powell referred this to as a mid-cycle adjustment, which was their way of saying that this wasn't the beginning of an aggressive cutting cycle. Well, the bond market really and the yield curve didn't put too much stock in that and continued the flattening trend and the inversion that they had been on the path for a number of months. And then as we got into September and the Fed cut for the second time, and they noted that they were going to act as appropriate, which, always gives me a chuckle because, you wonder if there's ever a condition where they would say we're going to act inappropriately. I would hope not. But I guess that's just semantics. But so you see right before that second cut, the yield curve started to steepen or move out of the depths of the deep inversion and began trending back to a more sloped yield curve. And then the Fed cut rates again at the end of October. And the takeaway there was then continuing to express that they're strongly committed to 2% inflation. So, the yield curve wanted rate cuts and the Fed begrudgingly gave it to them. So now when we look at where we are, we're in kind of this neutral zone where we don't have the market conviction for lower rates that was characterized through the last couple of months. So it presents a different landscape versus what we all saw and heard for the better part of this year. So, one of the good things that we have here at the bank is that we get an opportunity to see and talk with a lot of members of all shapes and sizes, and we get a feel for what's going on out there in terms of the challenges on the balance sheet. And we come across a number of common themes that are relatively consistent. So when you look at, when we've highlighted three things that jump out here in terms of declining liquidity and or an exposure to declining income in a falling rate environment, also the impact of elevated mortgage activity, and the relentless pressure on margins coming from both the asset and the liability side. So, what we'd like to do today is look at three different strategies to address these three challenges. And what's interesting is that they can be customized and tailored to whatever the specific magnitude that you may be addressing or want to address. But they can mitigate different types of rate exposure. So depending on your balance sheet positioning or your outlook, whether you've identified a down rate or an up rate or even a range-bound market, which is kind of what the market is expecting, well, there's ways to enhance the risk-return profile going forward. So we're going to jump right into the first strategy, and this is where you could potentially be looking to purchase mortgage-backed securities and funded by short advances. So, one of the things that we've been seeing and hearing a lot from folks is that they've been shifting more to an asset-sensitive positioning. And really, if you look back, coming out of the depths of the crisis in 2009, the banking industry has been building up capital to higher and higher levels, and that exposure, that positive exposure to rising rates, has really been a focus across the board. The second point there is something that we have been seeing and hearing a lot of, and it brings us back to the inverted yield curve that we were looking at a few slides and graphs ago, is that it's awfully tough to justify reinvesting cash flows or even growing the investment portfolio when we saw the levels of inversion between the short and the intermediate end of the yield curve that was prevalent through most of the summer. And when you take cash flows from the investment portfolio and divert them into the loan portfolio, that remixing of the balance sheet is one way that you can improve earnings and improve asset sensitivity. But the trade-off there is that that brings down on-balance sheet liquidity. And if we look back to 2007, 2008, hindsight being 2020, the best thing that you could have going towards the end of the credit cycle, and whether we're in the middle stages or the end stages of this cycle is, I don't have the crystal ball to tell you that. But the best thing that you could have had is to have high levels of on-balance sheet liquidity and also to have a level of asset duration exposure. So this graph will tell us about why this strategy looks relatively more attractive than maybe it did a couple months ago. And I will throw an asterisk in back to the beginning of the presentation, that the disclaimer that the Home Loan Bank does not act as an advisor or consultant, but we can show you some things and certainly work with you in putting together certain types of strategies here. So in green we have the level of mortgage-backed security spreads. So when spreads are widening, that all else being equal prevents some opportunity where you don't have to take the same level of risk, whether that's interest rate risk or yield curve risk or credit or prepayment risk, to hit a certain target yield projection. So, and in blue, again, we like to look at the steepness of the yield curve, because from a balance sheet perspective, it's less about the nominal level of rates. You can make money whether rates are at 7% or 2%. It's about the differential between points on the curve and where you place your assets and your liabilities. So when you look at the blue line there, you can see right around Labor Day was that peak inversion, and the yield curve has steepened, or we've kind of made up a little word here. It's uninverted or re-steepened, which we checked the dictionary. I think those aren't accurate, but they get the point across, in that the yield curve isn't as inverted as it once was, and it has added a level of slope back into the yield curve. So when you look at a strategy where you're looking to mitigate your earnings exposure in a down rate environment, then placing your assets a little bit further out the curve and funding it at the short end can be complementary to the overall balance sheet perspective. So, two things that we talk about an awful lot here at the bank when we're talking with members is to find the sweet spot where you're making strategic and opportunistic choices. So the strategic, first and foremost, is you want to make sure that what you're doing is consistent with the overall positioning of the balance sheet. So you need to know how much risk and return that you need and want. So when you look at your ALM reporting, and you can see that whatever contraction you might have for your income in a down rate scenario, well, you may want to mitigate all of that or some of it or most of it. So you can get a good handle before you start looking at a particular transaction or series of transactions to know how much you may need to accomplish in any particular strategy. And advances do provide an awful lot of flexibility so that you can really come from an asset-based approach. So on the opportunistic side is retaining some of that flexibility where you can look at opportunities that may present themselves on the asset side. And when you look at mortgage-backed securities, it's a very deep and liquid and diverse market. So you can find attractive structures, and you can get paid for different characteristics. And with advances, you can really customize the exposure that you want to have. So say, for example, you've identified that for a certain dollar amount of percentage of the balance sheet, you'd like to have around a 4-year duration. Well, that doesn't mean that you're limited to buying 4.25-year duration securities and then funding it with 3-month advances on a rolling basis. If you identify a more attractive or appropriate investment at the 7-year mark, well, you can extend some of those advances out to get to that net 4-year exposure that you may need or want to have. So depending on, this is something that we track very closely. So when you look at the infinite combinations of how you can look at assets and the series of or a blend of advances, you can put them together. Some examples that we've run for members, we've seen transactions where the spread can be anywhere between 75 to 125 basis points by putting on this type of a leverage program. And to give you some context for where that spread was, if we rewind back to the end of August, beginning of September, where the yield curve was inverted and MBS spreads were relatively tight, well, a strategy of buying a generic 30-year mortgage-backed security with funded by rolling 3-month advances actually produced a negative spread. So when you compare that to 3 months forward, as we sit here today, being able to get around 100 basis points, well, there isn't there's some opportunity there. And certainly if you sat here through the middle of 2019 and saw rates coming down and feel like you missed the boat a little bit on putting in some of that down rate protection, well, the market has come back and you have levels that are equivalent, or in some cases a little more favorable for you to put that down rate protection onto the balance sheet. So that'll lead us into strategy number 2, and this relates to the growing mortgage activity. So certainly the folks who are in charge with the origination and the secondary marketing at your organization, they have the great problem to have right now, where they have volume and activity and they're too busy. But from a balance sheet perspective, that can create some challenges, certainly on the growth side, because you do have so much cash flow coming back to you. So in contrast to the first strategy, where adding some duration will help balance out the down rate exposure, you may have a situation where if you're contemplating retaining some of your mortgage origination, that those are longer term assets, and your balance sheet or your outlook may not support having that level of interest rate risk on the books. So you want to be closer to neutral with anything that you're putting on. So that will require some funding that is not quite matched necessarily, but cognizant of the higher levels of interest rate risk. But as everyone here knows, one of the challenges with mortgage-related assets is that there's prepayment risk. So you may be towards neutral on day one when it comes to interest rate risk, but as you move into the future and some of those assets prepay, either based off of specific things going on with those borrowers or driven by market rates and forces, you want the flexibility and the ability to adapt as you go on. So similar to the first strategy, we want to set a framework for where we're at and how we got here. So here we're looking at the blue line being the 30-year mortgage rate, and green is the Mortgage Bankers Association Refi Index. And no surprise to many of us here is that the rates have come down pretty significantly over the last 12 months, and hand in hand with that, the Refi Index has spiked. So and when you notice that mortgages are path dependent, or rather the pace of refis being path dependent, a large swath of the mortgage market continues to be in the money and a potential for refinancing. So while we did see the spike in the third quarter into the beginning of the fourth quarter, absent a significant step up in rates, maybe not quite to the level that we saw in July and August, and certainly there's some seasonal effects that were supportive of elevated activity, that I wouldn't count on a significant drop in the refi and thus the cash flow coming back anytime soon. So the product that comes to mind when you talk about retaining fixed rate mortgages is a product that the bank has called the member option advance. So this is an advance where the member has the option to prepay the advance with no fee at a certain interval. So in the example that we're using here would be the 5-year, 3-year member option. So it's a 5-year final maturity with a 3-year lockout period, and then after that period, you have the ability to prepay it on a semi-annual basis. And what's really intriguing and a benefit of this re-steepened yield curve is that when we look back towards the middle of August, we saw that the 5-year, 3-year member option was priced at 224. And when we pulled the data for this webinar last week on the 5th, that rate was up just by 1 basis point. And interestingly, when we look at some comparable classic rates, the 3-year and the 5-year in particular, we see that those rates went up by much more than 1 basis point. So effectively, the cost for that option, the cost to have that great flexibility to shorten your liabilities when you most need it, went down pretty significantly. So there's some relative value there in terms of how that product can be used. And one thing that I will point out is many of the folks here are familiar with our Community Development Advance program, where the bank offers a number of different opportunities to access funds at reduced cost based off of certain loans that you may be originating. So this is available through this product as well. And when you apply that wrinkle to this structure, you get to a point where you get the same structural benefits that you get from having this option and this flexibility, but with further enhanced cost savings. So when you look at the CDA version of the member option advance, you're actually paying less than what you would pay for the 5-year classic advance, and only just 2 basis points versus that first interval of the 2-year. So you can get, like I said, the structural benefits, but some cost savings. And I would say if you're not familiar with that program, or you need some assistance in being able to fully utilize that, reach out to your relationship manager and they can walk you through that process. So the last strategy that we want to talk about is being able to tactically use the HLB option advance, which Dan had mentioned earlier in the call. And, different than the first two strategies where we talked about, an asset-sensitive positioning or increased mortgage growth, mortgage activity, that applies to some, most, but not everybody. But when it comes to the margin pressure, that is something that has been pretty consistent that we've been seeing and hearing from everybody, and of all different dynamics. So ways to tackle that is certainly front of brain for many. So and as we look at the expectation for rates to be relatively range bound, we talked about how no longer is rate cuts on the immediate horizon, and rate hikes aren't by any stretch on the horizon either. So now we're in this period where the market is expecting rates to be relatively range bound. And certainly when you look at the presidential election coming up at the end of next year, historically the Fed has not looked to make any drastic moves in times where there's a presidential election. 2008 being the rare exception, considering the state of the economy and the necessary actions that were taken at that point. But as we look at the shape of the curve and things and how things are shaking out, that a range bound outlook for rates is something that is front of brain for many. So volatility can tend to have a negative connotation in terms of as you're deploying your assets and liabilities. But Dan mentioned earlier that the structure of the HLB option presents an opportunity where, by granting the Federal Home Loan Bank an option to call the advance away, you get compensated for that. So as the volatility goes higher, that further reduces the rate. So I think a good way to look at this is to consider it as a comparable to certain things that you may offer on the deposit side. So, think of a scenario where a customer walks in and they want to take a CD, but they want you to waive the prepayment penalties and the early withdrawal fees. And for that right, they're willing to accept 60 to 65 basis points less than what the rate that you're quoting on the final maturity CD. So if they're willing to take in a lower rate, well, then that's something that you should consider. So here we look at the advance curve, and I put in a recent yield curve for advances, as well as the beginning of September, where the yield curve was deeply inverted. There's the green curve, and the blue curve is the more recent one. We can see we've returned to more of a normal shape. But when you look at where the HLB option is priced, that's those purple dots along the bottom, that there's between 40 and 50 basis points, not just versus the short end of the curve, but also the lowest point of the curve, which happens to be the kink at the 9-month sector of the curve. So there's some opportunity for cost savings and for margin relief. And now there's some risk involved, just like you would see in your deposit portfolios, where you'd expect them to move opposite from how a mortgage asset would work, right? So there'd be some extension in a down rate environment and some contraction in a rising rate environment. But in terms of understanding it and being able to explain it, we're here to help, and we can help you walk through some examples and show you the numbers about how it may be an appropriate solution for you to use. So those are 3 strategies that we've identified that can take advantage, and the value proposition has really shifted in these last couple months as the yield curve has gotten steeper or moved away from that inverted shape. So I'm just going to wrap up with 3 key points here that are pretty evergreen and things that we talk about all the time. So they apply now and pretty regularly, is to really look to balance that strategic and the opportunistic side of how you look at the wholesale part of the balance sheet. So your loan and deposit franchises are going to drive the ship, and rightly so. But when you look at the wholesale side, and advances in particular, they can really be used to customize and take advantage of shifting value, whether it's along the yield curve or certain segments of the market as spreads that contribute to what's going on. And most importantly, make sure that you're tailoring your strategies to fit your balance sheet. There's no one size fits all. When it comes to balance sheet management, it has to be a dynamic and a consistent process. So the great flexibility that all the bank products afford allow you to really fine tune things the way you need them to be. So with that, we'll wrap up, and I want to thank everyone for being here today, and to echo Dan's thoughts from earlier. If you have any questions, and a large part of what we do is based off of member communication and feedback, so we're here as a strategic resource for you. And if there's anything that we can do to help you navigate these choppy waters, feel free to reach out. All right. Well, at that point, I would like to thank everybody for their time, and thank you for joining us on today's webinar.